Hello everyone, I hope you're all doing great. We're here with another session of the price action course. In the previous session, we talked about trend strength and weakness. And if you've practiced based on what I taught you, you'll definitely notice how much you've improved compared to before in predicting whether a resistance level will hold or break, or whether the price trend in my trading time frame will change and go back up when it hits a support level, or if the support is more likely to break. Based on what we said last session and the distance and depth we'll add today, you can say that from now on, over 80 to 90% of the time, you can make an accurate prediction about whether a trend will change at a key level or zone, or if the trend will hold and just pause briefly in that area. Now, before we get into distance and depth, I want to talk about when we should actually look at a lower time frame. Well, we said we analyzed 3 trading time frames. We have a higher time frame, which is the 4-hour. Of course, in our strategy, your 3 time frames don't necessarily have to be the same as ours. We use these exact same time frames for our big alarm strategy as well. But you can choose those 3 time frames based on your own trading personality, and I've explained the ratios before. So if the daily is your higher time frame, your trading time should be 1 hour, and the lower time frame for checking details should be 5 minutes. We're actually using the 4-hour, 15-minute, and 3-minute or 1-minute time frames. Okay, the higher time frame was for defining our framework based on the swing highs and lows. In the 4-hour time frame, we identified decision zones and support and resistance levels. In the 15-minute time frame, the trend was important, and that's where we do our main analysis and apply the entry strategy we'll learn later. What are we going to do in the lower time frame? What's the point of checking the 1 minute if I'm already looking at the 15-minute? It's for when there's no clear signal in the trading time frame, which is the 15-minute for our strategy, meaning I see a shadow on the 15-minute time frame, and I want to go to the 1 minute to see exactly what's happening inside that shadow. Now let's go to the chart and I'll explain it to you. Or when the price is at critical decision points, like breaking a swing high or low, meaning a swing high has been broken and I want to see how the pullback happens, or if the breakout holds in the new range or not. Naturally, in a lower time frame, I'm looking at the chart with more detail, zoomed in, which gives better data, or when the price is in the entry strategy range, which is basically the decision area. Because the entry strategies for this analysis style I'm teaching you, once we get to the final sessions, you'll realize these are all the same trader decision ranges I discussed in the first sessions. It just gives you a specific formula so that if a certain thing happens, you should enter the trade. Let's go to the chart and see an example of how this actually works, how it gives us more data. I have a range here. A green candle has arrived, reaching my important range with high momentum. Now, I've marked this range on the 4-hour time frame, as you can see. Right? After this level is broken, a pullback to this point starts to happen. In the 4-hour, I have no data at all. In the 15-minute, which is my trading time frame, I see a green candle that reached this area with high momentum. Well, based on this candle, I might actually assume that the momentum and speed of the move are increasing, based on what I learned in the previous session. When I look at it in a lower time frame, I'll go to 3 minutes here, because we're on Solana. If it were Bitcoin or Ethereum, 1 minute might have been more useful. Okay, would I have actually seen this decrease in momentum that happened right here within that green candle that was formed for me? Let me make this white. I would see this. Correct. Can I see this engulf here? This red candle has completely engulfed or covered the range of the previous candle, which was green. Where do I notice this engulf and the probability of a reaction to this range when I'm looking at 3 minutes? I'll put this line here. Here, this engulf candle closes. I can enter a short position here because it was my decision range. Now I'll go to the 15-minute time frame to see where it could have shown me that, hey, Moen, you can short here. I am just now seeing a selling pressure starting to show up here. So I'd only see these two candles on the 15-minute chart below this one. Once this closes, I'd finally realize that, hey, something's starting to happen here. The momentum is shifting and the balance is tipping in favor of the sellers. But on the 3-minute time frame, I would have noticed right here that something was going on. So if I have those extra details within this decision-making zone on a lower time frame, I can make a much faster call. By this point, many have realized they should enter. But look at the price gap from the stop loss. Your stop loss for this trade should be above this peak at most, though I usually place it above the previous swing high. Ultimately, your stop loss needs to be right here. Now, compare the risk to reward ratio if you open the trade here versus if you wait and open it down here. I mean, look at how much larger your stop loss becomes. Now, that was just one example. You guys need to practice to really get the hang of this. This is exactly what the nature of price action is all about. Some of you ask, why do you explain so much verbally instead of writing it all down? Because in price action, we're not just drawing pictures. Price action is about understanding the meaning and logic behind these candles. In practice, it's all conceptual. That is, if you want to have the right perspective on it, the core concepts I need to teach you are verbal. The rest is up to you to go out, analyze more setups, and then come back and tell me, Moen Ghaffari, you were wrong here. Then I can explain my reasoning so we both learn more from each other. Now we've come to the fascinating topic of distance and depth. I touched on this in the previous session as well. What's even more crucial is speed and acceleration, or rather, the measurement of that speed and acceleration, which we call momentum. But I'll go over what I explained about distance and depth one more time on the chart for you. There's no need to memorize it. You don't need to memorize the exact textbook definitions I wrote in the PowerPoint slides. I'm looking for a downtrend. Where can I find one? Either a good downtrend or uptrend. Right. On this time frame, we can call this an uptrend. What do I mean by distance? Distance refers to the price difference between each swing high and the one before it. So this represents the distance of this particular leg. This price leg, from here to here, managed to push the next high this much further above the previous one. Now, I have another leg here that managed to push the high up by this much. What do I say here? I say the movement distance has decreased. Decreasing distance over time naturally leads to less momentum, and the movement's momentum drops. We talked about the decrease in momentum in the previous session. Now, besides this topic, well, look, it's not just one or two things. There are many factors that show you the strength and weakness of a trend. For example, the decrease in distance. Look here again. From this swing high, this movement step was able to go up this much. The next movement step. This was my main swing high. This was a complex correction. I don't consider this as the main swing high anymore. 1, 2, 3, move. This wasn't the swing high, the movement step. The swing high, it was a swing high that occurred as a complex correction, which we explained in the last session. I see here that from this swing high, I had an increase in momentum. Now, what do I mean by depth? If the momentum, if the distance increases as a trend continues, we can consider it a positive sign for the trend's continuation. If the distance gradually decreases, we can say that this trend is getting weaker and weaker, and the probability of a reversal is high. Now, regarding depth, what do I mean by depth? The amount that each correction can pull back from an upward movement, meaning the distance of the swing low from the previous swing low. Look, what percentage of this step has this swing low corrected? You see? What percentage of this has this swing low corrected? Compared to this entire low to here, how much was this able to correct? The closer the next swing low gets to that main low, the more weakness I'm seeing. These are strong steps for now because their corrections are small. Look at it this way. You don't necessarily need to memorize the word depth. For example, what's the depth of this here? Is this much? How much of the movement step has it corrected? It has corrected a higher percentage of this step compared to the previous ones, meaning it has corrected almost 80% of the step. So this step can almost be said to be weakening compared to the previous steps. As we go further, notice that the depths are increasing. What's the depth of a correction here? It corrects almost 100% of the movement step. Now, where is this matter important for us? This becomes important for us when we're in a decision-making zone in the 15-minute time frame or a lower one, meaning we're right here. Okay, this is where it matters to me, approaching this zone, whether it's with a weak move or an increase in trend strength, so I can decide whether to go short here or not, to sell or not to sell, or when I'm reaching it from above, whether I should buy here or not. Every time it's reached this zone, look, it's been with increased momentum here, and we see that it broke through afterwards. Watch closely. See? When it reached the zone again, you can see it even better in a lower time frame. Again, more momentum and a breakout. Where is the momentum starting to decrease? Look, now see how different the price reversal from this zone actually is? It was moving forward with a really high amount of momentum. But if you take a closer look, you'll notice that when it finally reached this particular zone, things started to change. Look at the depth of these corrections. How much this corrected from this leg and how much this corrected from the previous leg. Let's look at it from a momentum perspective instead. Momentum should increase, but it's actually decreased now. Here it was moving with maximum momentum. We had an increase in momentum. Near this zone, momentum decreases, the depth of corrections increases, and I can see that, look, the reaction to this zone could cause a trend reversal, meaning the level might hold. Look again at the pullback it made to this area. Honestly, I don't even need to explain it in detail. If you take a closer look, you'll see exactly what's happening in this touch and in this other touch, especially compared to the touch that occurs during the breakout. Just observe carefully, and you'll notice the differences between these touches and the one during the breakout. Which is the main point. This is what matters to me. Okay, principles of the future trend. So far, we've learned how to recognize the previous trend, whether it's bullish, bearish, or whatever, and then we learned how to analyze the trend's strength and weakness. And based on that, we now need to learn how to form an idea of the future trend, meaning if it's bullish now, will it continue that way or not? Or if it's bearish, are we going to have a trend reversal or will the downtrend continue? Let's have a vision like this for the future price trend and some principles that you must memorize, meaning they should become second nature to you. And I don't think it's anything too complicated. I'll also try to explain it simply for you. When you're within the framework of a support and resistance, meaning in the 4-hour time frame, I've made this a bit too cluttered. Let me define my framework first. Let's go here, for example. Let me see. My important support and resistance, the most recent ones, for instance. So what's the point? The point is that I've actually defined my parameters. My playing field is set. Now, for example, the price is moving between this support and this resistance. In the 15-minute time frame, now that I have a downtrend from the peak towards the bottom, what do I expect to happen? I expect the trend to continue. When might I expect the trend to change? Where it reaches the important bottom I drew in the 4 hour. Otherwise, I don't expect a trend reversal. Now let's look at the principles. We expect the trend to continue its path unless we see evidence of weakness or strength. Meaning, when I'm not at any bottom or peak yet, the price has moved from a peak, my trend is bearish, and in the 15-minute, I'm just moving down like this. Even though I had a range here too, but here the bottom of my range has been broken. If the range bottom broke, the range trend would turn bearish, right? Now, where my range trend has turned bearish, what's my expectation? My expectation is that this downtrend will continue. Then I usually use this arrow for it. I draw what I think is going to happen. After a while, it just comes to your mind, you know. But for now, draw it for practice. I have a vision like this for the trend continuation, and I think it'll eventually pull back to this swing low or this area to the bottom it broke before and move towards my main support, which was the swing low or my important zone in the 4-hour time frame. Unless, what happens? Unless I see weakness in the price movement. What does seeing weakness mean? It means seeing some factors we talked about before, like right here. Isn't this weakness? How much was the distance? How much lower has it come from this swing low? It's come down a lot more, hasn't it? Right? From this swing low, how much lower did the next step go? The price moved down much less than before. Right. Do you want me to measure it in price or percentage for you? For instance, I say you should be able to notice this visually. Right? What has happened to the momentum? The momentum has decreased now, hasn't it? So here, I can expect a trend reversal. It has turned from bearish to ranging. A trend change doesn't necessarily mean bearish turns bullish. Bearish can turn into ranging or bullish. Bullish can turn into ranging or bearish. A ranging trend can also turn bullish or bearish. It depends if it breaks from above or below. In classical technical analysis, someone might say a rectangle pattern has formed. Well, it's a range within a downtrend where I see a price range on a lower time frame. Well, whichever way this range breaks, as price action traders, we assume it'll move in that direction. There's no need to memorize pattern names anymore. Okay, I see weakness here, so I suspect the trend might change. I don't see any weakness here for now. Right? And my expectation is that it will move towards support. When we see signs of weakness in an uptrend or downtrend, the first possibility we consider is a complex correction. We mentioned this in the previous session. A correction where we might see lower highs and lows in an uptrend that don't break the previous swing low. Okay. Our primary expectation is for a complex correction to form before the price continues the trend. Mostly, we assume the current trend will continue unless proven otherwise. It's like the principle that a person is innocent until proven guilty, meaning it must be proven that you committed a crime. Otherwise, the presumption is innocence. Okay. Same here. The principle is that an uptrend or downtrend will continue, and we maintain that the trend will persist. Unless we see those signs of weakness, even then, we first assume it'll be a complex correction before continuing. If it persists further, we expect a range. Once the swing low that led to the highest high breaks, we then consider a trend reversal. We should then consider a trend change and confirm it. Well, we expect a neutral trend to continue its current state unless we see signs of weakness or strength at its boundaries. So we have a neutral trend within my framework. On the 4-hour chart, it's given me these highs and lows, right? Now, on the 15-minute chart, a range has formed where the support and resistance zones look something like this. This here is my resistance zone, right? And this area here is my support zone. Well, shouldn't the same principles we applied to the 4-hour chart for our 15-minute trend also work here for someone trading on an even lower time frame? We said that we expect the trend to continue down to this support level. Once it hits the support, we expect it to reverse and head toward the resistance. When it reaches this resistance, we expect it to pull back to the support. That's what we're anticipating. So when do we say our framework has been broken? When do we say the weekly trend has shifted? It's when these support and resistance levels on the 4-hour chart break. If it breaks to the upside, I'd say the 4-hour trend has changed. Right. So when I'm trading within this framework, I expect the trend to reverse upward at support on a lower time frame and reverse downward at resistance. On that lower time frame, it's the same here. When I have these highs and lows on the 15-minute chart, if I drop down to the 3-minute or 1-minute chart, I expect this to hold. It should range here, being bearish down to this point, then bullish up to here, and bearish again down to here. When do I expect a support or resistance level to break? Where I see strength as the price approaches a specific zone. Okay. Where I see an increase in momentum and speed as it nears the resistance level. So we expect this to hold unless we see signs of strength at the support or resistance levels. Now let's go back to our primary time frame. We expect the price to gradually show some weakness as it approaches this important zone, which could lead to a trend reversal toward our resistance level on the 15-minute time frame. At this stage, it's a good idea to watch for any signs of a shift in momentum, since this area often acts as a turning point in the market. Got it. Unless we see signs of strength here. Unless we see that the sellers are stronger than the last time the price hit the support level. I guess I'm a bit obsessive, constantly re-explaining those signs of weakness and strength from the beginning. Please bear with me on that. You really should have mastered this by now. I shouldn't have to keep repeating myself. When we see signs of strength at the boundaries of a neutral trend, we expect those boundaries to break. We then analyze the price action after the breakout as a clue for the next trend. Just like what happened here on the lower time frame. What was our previous framework here? We expect this floor to hold unless we see signs of strength, which we're seeing right here. Now, once it breaks this boundary, we'll wait to see what the pullback looks like. Basically, whether the price is accepted in the new zone or not, and if the pullback or return to this level is accompanied by weakness or strength. If our pullback shows weakness, then naturally we should open our short position in the direction of the downward trend that led to this floor breaking. I'm breaking it down for you step by step. When I have a floor and a ceiling within a neutral trend, it just keeps hitting the ceiling, floor, ceiling, floor. When the price reaches a floor and we see signs of strength, we expect a break. But it might just be a shadow and we return to where we were. So in that lower time frame I mentioned, which can give us more data, I can go and see exactly what's happening inside the shadow. Is it a relatively weak break and a stronger pullback where I'd expect to see a shadow and then a return on the higher time frame? Or will I see a much more powerful break and only a weaker pullback? If after a price break, meaning a floor or ceiling is broken, we see weakness in the trend, we expect the price break to fail. Let me see if I can find an example, because I don't look for examples before filming. I prefer to show you during the video, because otherwise, it might seem suspicious. Many people find exactly where their strategy works before recording their course. Show you that and you think, wow, why doesn't he ever make a mistake? For instance, if they want to teach an indicator, they'll pick exactly the spots where it worked to show you as an example. Since I don't like doing that, it might take a bit of your time for me to find a proper example. Let's see, we expect the price break to fail and the price to return to the previous range. Well, we didn't have these ceilings before. Let's assume we had these two ceilings and we thought this was a resistance zone. When my chart was here, I was only seeing this part. This was my ceiling, and when the price reached here, I could say a break occurred. Right. The nature of the pullback that follows after this break can actually be quite decisive for me, because it shows whether a ceiling was truly broken and the trend is likely to continue, or if instead I'll end up returning to the previous zone. Now let me go to a lower time frame, because we need to go to the 3-minute time frame to see this. I've already drawn these, of course, so we can find it now. I thought I might not be able to find it again. For example, right here. Okay, now let's go to the lower time frame. There was a bottom in the 15-minute time frame, and in the lower time frame where, let's say I want to trade, I'll see if this breakout was strong or not. Look, I see a bottom was broken, whereas I only saw a shadow there before. But when I go to my trading time frame, let's assume 15 minutes was the structure time and 3 minutes was the trading time, a level was broken, and I see a stronger pullback compared to my breakout. So I expect it to return to the previous area again. When it returns to the previous area, I expect that in this range, if the price sees this level again, it will move upwards. And when it breaks, what happens this time? Do I see weakness in the pullback, or do I see weakness in the breakout? Here, my breakout is strong. And how much percent has my weakness even been able to correct from the price move that caused the breakout? Ryan, it hasn't even been able to come back and touch the previous area. But what happened here? My correction has come and engulfed 2 or 3 candles before itself. Again, when it came into this area, the price wasn't accepted, and my correction completely engulfed the 2 candles before it. So these two are different from each other. This pullback compared to that pullback are 2 different pullbacks regarding whether this range's bottom will break or not. This doesn't tell us this bottom will break, even though some people might say, oh, they're here to grab liquidity, the price is about to skyrocket and all that, but we don't pay attention to that. Let them go play their own games. Let them just play around for themselves. Alright, we've discussed some principles within the support and resistance range, meaning within the framework. The price hit a peak, it's in a downtrend, right in the middle of the path. We expect it to keep dropping until it hits the floor, okay? We expect that if a rah-rah range forms in the middle, this range will continue. If the floor breaks, we head towards the 4-hour floor. If the ceiling breaks, we head back towards the 4-hour ceiling. If I see a range on the 15-minute chart while moving between the 4-hour ceiling and floor, I expect it to continue unless either the floor or ceiling of that range breaks, so I can see which way it's headed. And when I finally reach a support or resistance level, what should I expect then? I want you guys to think of this within the framework as being within the support and resistance range. The last one was within the framework while we were in transit. But this time, when we hit a support or resistance zone, we expect that support or resistance to hold firm. It's just like the range we talked about in the previous section. We expect support and resistance to hold, but what does that actually mean? It means we expect the 4-hour time range to hold steady. For us, on the 15-minute time frame, that's a trend reversal. That floor and ceiling are part of the same range we see on the 4-hour chart. Now, we expect this to hold unless we see signs of strength as it approaches support or resistance, which brings us back to the range we discussed earlier. If we see signs of strength as it nears support or resistance, then we're expecting a breakout. When we're approaching support with a lot of momentum, we don't go long. When we're approaching resistance with a lot of momentum, we don't go short. We expect it to break through. But if it does break, do we go long immediately? No! We wait to see if the pullback is weak or if it's stronger than the breakout itself. Just like the example I just gave. There's no need for me to give another example. I want your mindset to be like this when looking at the chart. So you're not just thinking linearly, like I have to mark this on the 4-hour and then do this on the 15-minute. Look, this range you're seeing here on the 15-minute chart, many people use that as their primary framework and then trade on the 1-minute or 3-minute charts. It's the exact same principle. So this floor and ceiling serve the same purpose as our floor and ceiling. We said whenever the price hits this floor, we expect a trend reversal unless it approaches with a lot of momentum. Whenever we hit this ceiling, we expect it to move back down unless it approaches with a lot of momentum. If this ceiling breaks, we wait to see if the price is accepted in the new range or not. I mean, is the pullback weaker or the breakout? A weak breakout and a strong pullback can cause a return to the previous area. A strong breakout and a weak pullback can lead to a continuation of the move. And it's the same for support. Now, if I have a range here as well, the trend didn't come down in a completely bearish way to reach here directly. I saw a range. I expect this range to hold. Just as I expected this resistance and support to hold. Unless I see signs of weakness near this floor or this ceiling in a lower time frame, of course. Here, when I'm drawing this ceiling and floor on the 4-hour chart, I come and trade it on the 15-minute chart. If I have a ceiling and floor here on the 15-minute chart, then that trade belongs to the 3-minute chart. But you're not supposed to catch everything. You define a time frame for yourself, and you only work based on that. I won't, as someone waiting to short here or long the breakout of this or short the breakout of that, I won't go and scalp a range I see along the way in a lower time frame. You have to make your decision. Which one of these are you? And which one of these time frames do you want to work? Otherwise, you'll get into it. You'll get drowned in the middle of it. You'll keep saying, well, since it's a range here, why should I short here? Now that thing happened over there. You should have, in fact, a trading system, a strategy for your entry into a trade, and you should also have a time frame system. I use the 4-hour and 15-minute charts, and I'll do the same forever. I won't open a trade on the 1-minute chart anymore. Even if I'm sure this ceiling and floor will give me profit 20 more times, I won't trade here. Oh wait, this is my long spot and this is my short spot. Now, depending on whether it approaches with weakness or with strength. I hope you found this video useful. If so, you can support us with your valuable likes and comments. Until the next video, goodbye. Have low losses and be successful.